But let's start with these markets. As we just heard Brian mention, the S&P and NASDAQ record highs again. Some of the blue chips, though, like United Health, Honeywell, IBM, those are dragging the Dow down 0.5%. Our next guest says it is time to take some profits. She likes tech, but is also getting defensive with these healthcare and utilities plays. Joining us now is Emily Roland. She's the co-chief investment strategist at Manulife John Hancock. Emily, it's good to see you. So is it time to look at, again, look at the news flow on United? It reminds me of Boeing a few years ago. Is this a moment for you to get into some of these healthcare names, and if so, why?
What we're looking at right now is really finding opportunities where there's an intersection with solid technical trends. Momentum by far has been the best performing factor this year, chasing winners. We want to be there, but we want to think about combining that with quality. So looking for opportunities in stocks that have great return on equity, good free cash flow, really an ability to maintain margins at a time that they're coming under pressure. So that's leading us to overweights in areas like tech stocks, communication services, healthcare, and utilities. One thing we've been looking closely at is the PEG ratio. I don't want to get too technical here this afternoon, but
they're talking about this. PEG ratio is having a moment. Go ahead.
It really is. And it's about kind of not just momentum, but quality momentum. So it really measures how much you're paying for future earnings growth. We want to be thinking about ways we can manage valuation risk while still participating in markets, because a lot of things are going right. The technical trends are there. Earnings growth is holding in. The economy is doing all right. The biggest risk to markets right now is that there is no risk. The S&P 500 is trading at 22 times forward earnings. 24 is the highest we've ever gotten to in the late 1990s. High yield bond spreads, which were a measure of how much risk is being thought about in the market, at 280. The tightest we've ever been is 230. That's back in 2007. So we just want to be mindful of reaching too far for risk in a period where there is a significant sense of overvaluation across assets.
You're making all great points. The problem is nobody has seemed to care. If your name's not NVIDIA or has AI attached to it, the markets have kind of ignored it.
Well, there has been some broadening out. We've seen areas like lately, yes, very lately. Financials, industrials, really, honestly, Brian, everything is up. This is just one of those everything rallies where markets are brushing off every risk that's come its way. And we've also seen tariffs really lowering the bar for earnings as well. 5% earnings growth was a low bar after double digits last quarter. And we've had this cacophony of events, from tariff announcements to supply chain concerns to this massive roller coaster of sentiment, with consumers having deeply, deeply negative sentiment to start the quarter. And now we're seeing just absolute surging sentiment. So there's been a lot for companies to navigate. And I think analysts are saying, hey, you did a pretty good job and you maintain profitability here, you get an A+.
Right. But basically, it's always, you go, okay, let's say the market faces some turbulence. Fine. Like, for instance, we go back to December, January, we're having some similar feelings, and we ended up with this big sell-off. But look at the performance coming out of the sell-off. Healthcare is still atrocious. Tech is still leading. So it just makes you wonder, well, if you rotate, you're going to rotate in what? Try to then rotate back as soon as the correction's over? It just... Maybe that's what professional management is, but it feels like it's just really hard to do all of that timing.
Yeah, there's definitely a buy the dip mentality. One thing that I would point to, though, is everybody's talking a lot about tech, but actually the best performing asset globally has been European financials. That has been the trade, just absolutely incredible performance there. And frankly, the earnings haven't been there. So we've seen this sentiment-driven rotation, capital flows leaving the U.S. and actually investors allocating assets towards Europe. And just, again, negative earnings growth and 30+% returns year to date for European financials.